I'm thinking about bonds and what I want to ask you, and it's this. Yesterday, the two-year yield was up, 145 basis points. It was a huge move over the course of the quarter, okay, which we're almost on ending now, the first quarter. You couldn't see anything like that unless you a move in the two-year note yield, unless you go back to 1984, okay? So I'm thinking the Fed's done a 25 basis point rate hike, and they're saying they might do 7 more, right, or 8 or whatever. They don't know for sure, depends on the data. So when you look at where the 10-year note yield is, for example, is it kind of where it needs to be? Does it need to rise further? I mean, is there a way you can calculate that?
That's a great question, Kathleen. I think what the market was doing was actually saying that the Fed really needs to front load these rate hikes. And the reason has to do with the fact that we're seeing inflation. So I'll just say it, war is inflationary. And I think what people are coming to is just a realization that, unfortunately, this Ukraine-Russian conflict is probably going to be lasting longer than what most people would want. And so the Fed needs to actually build up its ammunition, because what is most likely going to happen is that overall global growth is going to be dampened. And as a result, they need to actually be able to cut rates later on should this have a greater than expected recessionary effect.
So if you're a long-term bond investor, do you still keep your powder dry? I assume you do, because you could say, well, if it's going to have a recessionary effect at some point, you could make money depending on how high the yield gets before you jump in.
Well, so here's how we look at it. So if you think about the 10-year yield, right? It's really driven by global PMIs. It's not just the US, but the US bond market really encapsulates all of the risk globally. And what we've seen in our model is that as inflation has actually been going up, we need the yields to go up. But then it's actually being counteracted by the fact that global PMIs are actually slowing somewhat. So we're seeing fair value of the 10-year at around 2.7. And if anything, I actually expect that to go down a little bit. So, maybe we have another 20 basis points to go up from here before I think it's actually time to buy duration again.
Teresa, when you take a look at central bank divergence, but also, as Mary Daly pointed out, part of this entire policy adjustment cycle is what other central banks are doing, the likes of the RBA, the likes of the RBNZ, right? Where do you see opportunities in rates outside of the Treasury market?
I think it's really hard to call at this particular moment. I think that there are a lot of uncertainties right now, and all of the central banks are just really looking at the risks and how the numbers will be looking before they really, move. And so there is just going to be substantial amount of volatility. I think the only market where we're actually not seeing substantial inflation right now is China. And because China has stockpiled so much commodities over the last 2 years, whether it's soft commodities like grains, all the way to energy, as well as metals, they may actually be the most insulated from this commodity price hike. And as such, we actually think that the Chinese rates market may actually have more room to fall. So if there's really one market that I could point to where you're not going to be hit as much by the inflation, would be actually the local China rates market.
Let's stay with China, and I want to get your thoughts on Evergrande. Is what we're seeing when it comes to Evergrande representative of the broader property market and even broader distressed developers? And do you see opportunities there?
That's a really great question. If you were an actual creditor to Evergrande right now, you need to be watching this play by play. But I think for most of the bond investors in the China property market, Evergrande is not symptomatic of the rest of the market. I just want to draw a really clear distinction. Evergrande, we think, has a real solvency issue, which just means that they have probably more liabilities than their assets can cover. But that's not the case with most of the other China property developers. In fact, most of their issues stem from more of a liquidity problem that's externally driven by poor sentiment. And what the implications are is that if you do own good companies with strong fundamentals that are potentially just looking at a liquidity problem in the short term, your recovery is going to be so much stronger. So we're talking about potentially par recoveries here. So for many of the high yield names, we actually think that if you are a long-term holder, it may not necessarily be a bad time to start dipping in and buying.